Hey, welcome back to the Presidio Perspective. Dustin and TenBroeck here, certified financial planner. With me as always, Jeff Anderson. Not always. You weren't here last time, but it's good to have you back.
I got my car.
Yeah, congratulations. Absolutely. Look at that. The supply chain's all put back together. Yeah, that's nice. And it's not oil dependent.
Right.
Yeah, so good timing.
I've enjoyed that.
Yeah, absolutely.
We'll get to that later.
Yeah, so we had a great episode last week without you, and I was just hoping there wasn't some market capitulation. Like, can we have one, week go by without the markets panicking or out some news event or whatever? So yeah, it was a good one. But anyway, back to all the worry, right, that everybody has. Here we go. The first quarter results are in. It was a bad one. It was a bad one for the stock market and the bond market. It's a bad one at the gas pump and inflation eating up our budgets. Interest rates are rising. Things are costing more. Our money's making less. Anything that worked before didn't work this last quarter. So investors are pretty worried, I would imagine, right? We have war, we have inflation, we have interest rates, all that stuff I just mentioned. So I kind of want to just talk about all of those things and what we're worried about and what we're not.
Right.
So and if I could tee you up a little bit, like inflation, we talk about it a lot, right? It's one of the big three: inflation, taxes, market crashes. People hear me say that over and over and over, and here we are. So, I hear a lot of parallels being drawn to the 70s, right? And I think it's important because that was a really tough time for investors and just U.S. households in general, right? And we've seen oil spiking, inflation. War, right? Unemployment. Well, that's not really there yet.
We're talking about the 70s.
In the 70s, right. Okay. But I mean, the parallels are inflation, war, and down market. So tell us a little bit, right? Are you concerned about inflation right now?
No, not really. I mean, it's hard to say that when everybody thinks we're going to peak at 9%. I mean, that's just an enormous number. Mm-hmm. I mean, we've been running these assumptions, and the Fed's been trying to get inflation to 2% for how long?
Right.
The last 20 years?
Yeah.
And then we got to 4, then we got to 5, then we got to 7, then we're at 9. And everything that I've researched really think that we're going to peak probably as we speak. So numbers are going to start to come down. Inflation's going to start to come down. And the Fed raising interest rates is what's their mandate. We talked about it before, where it's two things, right? It's full employment and inflation. Mm-hmm. They've got employment where they want. The economy's still strong. Yeah, it's decelerating, but still growing. Mm-hmm. But inflation is pernicious, and it's not as transitory as they thought it was. And they're increasing interest rates. Remember, we talked about the podcast in the beginning of the year, where all of a sudden at the end of the quarter of 2021, we thought we were going to get 1 or 2 rate hikes. Then there was going to be 4. Then there was going to be 7. Then there was going to be 9. And now the Fed has said, we're committed to inflation. We think the economy's strong enough.
So they'll do whatever they need to do
to get down inflation, right? And part of it, too, is to take out some of the excesses in the market. And you think about those meme stocks.
Well, they did a lot of that already by just talking about it. Right? Well, I mean, that's really what we saw in the first quarter.
And one of the genius things about Fed Powell, if you can call it that, is, just the rhetoric alone can do some of your heavy lifting.
Right.
Just talking about what you're going to do, it takes the kind of the fluff out of that stuff. So,
past Fed chairs, just based on my experience, pretty much said, here's what I'm going to do, and then they did it. I mean, that was just, what I remember with Bernanke and Yellen. It was like, don't fight the Fed and don't try to guess that they're going to do something that they said they, other than what they said they were going to do. Do you feel like that's the same thing with Powell?
Absolutely not.
Yeah.
He's 180 degree he's not an academic.
He'll change his mind.
Absolutely. In fact, he's even said that, at times he's changed his positioning based on doing research on the weekend like you and I do.
Well, and absolutely, we've seen that, right? Because it was all transitory. And obviously, that's the 180 degrees you're probably talking about, right?
Well, when it came to that transitory argument, we don't want to belabor the point too much, but everybody was saying, when he got in front of Congress, they're saying, hey, it's transitory, it's not transitory, would you stop using that term? And he said, listen, my definition of transitory means it's not permanent. Your definition of transitory is something different. You
Gotcha.
Think it. So I'm not going to use that term anymore. And everybody said, oh my God, inflation's here forever. he's way behind the curve. And
Yeah.
he just said, listen, we're going to differ on a definition of a word, so I'm not going to use it.
Did you see that lightning in our studio today? That was crazy. Just kidding, Sierra. Yeah, no, absolutely.
So getting back to the 70s, let's
Yeah.
just tie that up so we can move on. One of the things that's interesting is that you're seeing oil prices. The price at the pump, $6+ for gas in California. It's always been expensive, but it's particularly expensive. We don't like paying it. I do have another car that's got gas in it, so I did have to fill up yesterday. It was painful. But what's different between now and the 70s is oil as a percentage of disposable income is half of what it was. And that's a big number. So it's not quite the same. Inflation was running much higher. We had a dollar that was crashing when we left the gold standard.
So what's the percent of our budget now?
It's like around 4,
And what was it in the 70s?
8+.
So
It was double.
That's for after whatever your disposable income. Here's what I have to live on for the month. 8% of that was going to energy consumption versus 4% today,
Right.
even at these elevated prices.
Doesn't sound like a lot, but it's a lot.
Oh, that sounds like a lot. Absolutely.
8 cents of every dollar versus 4 cents.
Well, it's really important when it comes to things like the stock market and real estate, right? And the things that we invest in, because if that money's going to pay at the pump, what is it not going into?
Right.
It's not buying a new Apple Watch, right? It's not doing an addition to your house or remodeling your kitchen or buying the S&P 500, right? It's going to that. And so that is a pretty big percentage of, the household disposable income.
And you're still seeing it in the market, the 4%.
Yeah.
In the fact that consumer discretionary stocks are doing better and commodity stocks are doing better, and discretionary is not doing as well, but the durables and the defensive names are doing better. The ones that kind of think about the things that you need to buy versus the things you want to buy, right?
Right. And I think it's important to note, like, why is that? It's like, well, the U.S. was not producing its own oil. I mean, we were dependent on foreign oil in a big way.
And that's not the case
And a
today.
lot of
We're
our
the swing
clients
producer
remember
now.
that. Yeah.
Right. We are not dependent on Russian oil, not to the point that it can really affect us. But WTI, which is what's priced in American oil,
Yeah.
is pegged off of Brent crude. It's a problem for Europe because they get 50% of their gas from Russia. It slows down the economy. So, it's Europe is not doing as well as the U.S.
Right. Absolutely. They're going to be much more impacted by this and have more of an inflation fight, sounds like, with the Ukrainian-Russian crisis.
Right.
Yeah. Okay, so we aren't worried about inflation. So interest rates, because interest rates are going to be rising. Okay, so that's going to have some market capitulation, I'm assuming.
Right. Well, there's 3 things to think about with interest rates: mortgage rates, we'll get into that, the bond market, and then just stock market. And we talked about this before, right? We talk about that in Wealth Management 101, which is everything is kind of the present value. When you say to somebody, you have $5,000 a month you need to spend, and in 10 years from now, 3.5%, you're going to double that.
Yeah.
Or you're going to need 50% more. So the stock market discounts everything back to today, but how do they do it? They do it with interest rates. When interest rates are higher, the discount rate is higher, and then the value is lower. So it makes the stock market maybe more expensive in the short term.
I think it's important to pause for a second, because when we think about all of these worries that we're talking about, 5 years from now, we're not going to be talking about this stuff. And this is just a blip if not 5 months from now. And we get to know that because we do this podcast, that the agenda keeps changing, right? Of this wall of worry we keep talking about. But, I think that it's really important for investors to, it's one thing to be well-read and knowledgeable about what we're doing, but this is pretty minor stuff in the grand scheme of things when it comes to the long-term value of your portfolio. I mean, there's always that wall of worry. There's always something to be concerned about, right? That makes you want to second guess, your kind of long-term investment objectives. But the data is out there, right? I mean, we've seen what happens. You shared with me this piece yesterday, when we look at stock market returns after large first quarter declines. Let's just look at the averages, right? So we've only had a few times in history where the stock market drew down by the S&P 500 by more than 10% in the first quarter. And 1933, down 15%, rallied 70% for the rest of the year there. 1935, 1938, very similar. 1939, okay, a lot in the 30s apparently. Volatile market. Gosh, remember those days, Jeff? Bet you do. 2001, right? 2001 is the only one that didn't have this big rally. Well, because the first quarter of 2001, you had the correction from the tech wreck, right? I mean, you had these crazy valuations coming out of the 90s and 2000s. And it was rallying, and then something happened that September 11th, right, in 2001. And, so it finished just about where it was at the bottom of Q1. But, I mean, that's a pretty, black swan event that nobody was, could forecast.
And you could worry your way out of your portfolio with just those, this first quarter. I was like, it's over.
And in 2020, of course, we had COVID. It drew down more than 20%, and then all the way down to 34%. But from the 20% drawdown, rallied another 45% from there. So history shows us that in a first quarter, it's a good time in history to buy, historically, right, if you look at those top 500 companies on average. And I saw a really interesting article that I shared with you this morning, right, that we saw in Finance Yahoo, that right now we have more analysts. We have, what's the statistic? We have more buy. Let me just read it. According to new data from FactSet, analysts had the most buy ratings on stocks in the S&P 500 as a percentage of their total ratings during February and March in over a decade. Out of the 10,821 ratings on companies tracked by the benchmark, that's the S&P, 57.3 had an investment analyst recommendation to purchase the stock, and 57.4 in February. Prior to the surge, the last time the percentage of buy ratings exceeded 55% was at the end of any month was September of 2011, when it was 55.8.
Let's talk about that one. I think that's interesting because that brings us back to the lows of 2009.
Yes. Okay.
And what happened? The S&P cratered, went to 666 or something. It was some crazy number.
Yeah.
And we embarked on QE, and then the Fed came out and said, what?
We're gonna pull back QE.
We're gonna pull back QE.
Yeah.
I think investors looked at it and said, market's up 60-something%. That's it. We've had this great run. It's time to get out. Market took a little bit of a pause.
I remember investors going to cash when that happened.
Right.
Yep.
And so a little pause, went up again, and then had another little pause in August or July of August of 11. So now the market's up 80 or 90%. People are thinking, geez, I mean, look at this. This is fantastic because the economy can't stand on its own and the government's going to remove QE. I got to get out. And that's when the analysts came out and had that buy recommendation of 55%.
Yeah, it dropped pretty significantly, right, in 2011. And when I look back at the chart, it's rare that you find analysts that get it dead on perfect. It was literally retesting the lows prior, right? And it was the exact bottom of the S&P 500.
Where'd the market go from there?
It never went back. It went surging up 100% over the next 5 years, and then another 100% over the next 5 years after that, bringing us to where we are today. So, analysts get it wrong, but it's given me a pretty good confidence that this is a buyer's market, right? The prices are lower than where they were prior. That is usually in history a good time to buy more, not sell more.
Right.
And if we can just encourage investors to ignore the wall of worry and not guess what Powell's going to do or what the next inflation reading, it's fun for us to talk about. And of course, we're looking at making changes on the margin and positioning portfolios to, be able to handle the volatility. But the long term, the number one thing we do here at Presidio and as wealth managers in general is create your time horizons and your long-term holding period so that you don't have to worry about it.
Right.
If you look at that wall of worry and you look at, we shared it before, we can share it again and we should. So, we'll bring up this chart that if you look over the S&P 500 since 1937, probability of positive returns is over 1 year periods up 77% of the time, 3 year periods 87% of the time. 87% of the time you're making money over the next 3 years. 92% over 5 years, 97% over 10 years. are those good enough odds to just not mess with it?
Imagine going to Vegas with those odds.
I know, right? And I think that's what a lot of people do when they make these massive changes in their portfolios, and they become reactionary, right, with fear and greed. And the fear, and I'm not sensing a lot of it out there from our clients certainly, but I know that there's always some next event that's coming, and there is some worry when you do see the markets just they go down temporarily, they go up permanently, and we're seeing this happen right now, and the wall of worry is there, but staying long term, those odds are just in your favor. But I mean, a lot of people will get scared, and it's that propensity to go to cash or to start cashing out of the market. And I think that that's a really dangerous thing for people to do, and not something that generally works over periods of time.
I would love investors to have that chart up every time that they have this impulse that they want to sell. Go look at it and try to remember those periods where you remember panicking, and look at those things, and then you have to be reminded by looking at the chart.
Yeah.
But we talked about it before. Time in the market never works, right?
Timing.
Yeah. It's time in the market.
Time in. Yep.
And we know that the historical rate of return on the S&P is something like 9.8% over the last 100 years.
Yeah. It's
close to 10%. But there are very small pockets of time that had huge returns that if you were not in the market, you didn't get that 9.8%. Mm-hmm. And just because the average is 9.8, I think everybody knows this, but restating the obvious, you're going to have pockets where the market's up 20% for 3-4 years, and it's going to be down 30%, and then it's going to be up. And the average is going to be that 9.8. But if you keep making decisions, you're just going to trade your way out of your retirement nest egg.
Yeah, we have a lot of data on that, actually, of what investors have done versus what the index has done over periods of time, which is really interesting. We'll bring that on the next episode. But, we talked about, what's working, what's not working so far in 2022. And not that we're, pivoting every quarter, right? Because that's just happening. But, it's people to understand what they're investing in. And if they have a fund that's down a lot, this quarter, that's pretty common for a lot of, especially if it's something that has been working well historically. And so, Cathy Wood, most famous person on Wall Street over the last 2 years, and now fame or infamy, it's like here we are, the top performing manager investing in innovation, technology, genomics, internet, crypto, blockchain, the next thing, right? And which just killed it in 2020 and 2021 up until November of last year.
Right.
And
they gave away those stocks gave away almost all their gains in a quarter.
She was actually, I just read, the worst performing fund manager on Wall Street for the Q1 of 2022.
Yeah, and coming into Q4 of last year, the best performing.
Yeah.
And if you had FOMO, you probably didn't get to ride it from the beginning and get that
big
and still be up.
After it went up.
You chased it up, you lost, and then you're sitting there, and what are you doing? Most people don't get those returns. So we'll talk about that in another podcast.
But I think that's also important of people being long-term and people being diversified. We talk a lot about these, time in the market and the strategies. That doesn't mean you put all your money in one basket, right? You can be wrong.
You can have too much of anything.
Yeah, and it could be highly sensitive. So it's really important for investors to know what they're investing in, make sure they understand the risk tolerance, and then down, what goes up, right? That's just the FOMO. And then we are seeing what happens on the other side of that eventually, you say it all the time, I say it all the time, is the market going to crash? Yes. Is your investment going to stop working? Yes. There are going to be periods of time where that is challenged. And, is Cathy Wood right? Sure. Absolutely. She will be right again. That strategy for growth and innovation and technology is going to have its day in the sun many, many times. And this is just the volatility that happens when you invest in growth.
Right.
And, so when things are working, and you are participating in that is fantastic, right? And some investors want that. And it's just important to know that if you got that, you're not experiencing FOMO, you will have the FOLO. You don't get both. If you want to ride that train, okay, you are going to have to experience these pockets of underperformance. It's just part of the game, and it's not going to happen any other way. So don't think you're going to create some perfect investment.
And it's never going to change.
It's not going to change. You're not going to call it. You're not going to get the top or the bottom. No one's going to do that for you. They're liars if they say they can. Don't assume that you're going to do it. You're going to get it wrong. You're going to lose, right? And so that's why having a diversified portfolio, having different eggs in different baskets is helpful. But if you're concentrated, just know the game you're playing. Because, you look at Cathy Wood, understand that makes sense for a lot of investors. And hopefully they knew what they were in for. And I think a lot do. They say, I'm going to buy more. I believe in this is my 10-year money, my 15-year money. I don't care if it's down for a quarter. What's one quarter in 15 years, right? There's 60 of them. That's like watching one down of football and determining who's going to win or lose the game.
Right.
It's actually an exact analogy. It's actually a half a down of football. There's about 30 of them, right? For each team.
Right.
So, I guess that would be each team. I guess that'd be 60 quarters. So figured out that math. There you go. 4 times 15. But I mean, that would be insane. But that's what we're doing when we look at our investments for one quarter, right? It's a long game, and it's a game of inches. And just like football, it is here in investing too. And because the other side you look at is like, okay, well, if you've been, a value investor, first of all, you're not around anymore because you got fired from your job. Investors that wanted to go find a good value manager, like, oh, show me a good value manager. You had some slim pickings. They're gone. Value hasn't worked in 10 or 15 years. Anybody who has value has been fired because something's not working, and now it is, right? And so you look at, I think of Warren Buffett, right?
The ultimate value investor,
yeah,
who is not what you associate with mutual fund value.
No, but what is Warren doing today, yesterday, first quarter? He's buying. He's been buying. He's been buying Occidental. He's been buying HP. He's been doubling down on some of his portfolio. So he is buying in the bad market. But anyway, the point is, he's going to give you the FOMO,
right?
Because when all that stuff's working, right, really well, all that growth is happening. That stable investor, right, is going to give you the FOMO, but you don't have the FOLO because, how are they doing this year? Really good,
right.
Better than anybody. Right? So which one do you want? They might both get you to the same place. Do you want to experience FOLO or FOMO? Okay, because you're going to get one. Or do you invest in both? Do you have a diversified portfolio that's going to have different things that are working at different times? And that actually gives you a really good winning scenario with rebalancing. Because what you can do is sell the thing that's working, right? Buy the thing that's not, and they will revert at some point. And that's a strategy to buy low and sell high, which is how we make money, isn't it?
It's the opposite of our financial defect, right?
Our financial defect is to buy high and sell low. And I mean, that's everything that we're talking on this podcast is just don't do that. And if you want to rebalance your portfolio, you can look at different strategies. But I want to end it on this. Another thing you sent me that is just so valuable, I think, and it applies. We'll probably read this quote over and over and over, but as it applies to different asset classes. But this theory of escalation of commitment, which is a psychological phenomenon researched by Professor Barry Straw, of kind of negative reinforcement or negative events having a positive reinforcement. And this phenomenon is shown in religious cults, especially those focused on the end of the world, right? But it shows up in wealth management, and it shows up in our investment decisions. And, this is when, you think about escalation of commitment. So let's take these religious cults with, the world's ending. And so now you've joined this cult, and you can't talk, you disassociated from your friends and your family and your husband or your wife, and you can't talk to your kids or raise your children, and you might have mutilated yourself, whatever this thing was doing, right? Give up all of your money, right? Give up all of your education. These are what these kinds of things do. It's because it's an escalation of commitment that once it gets to the point where we are about to jump off the edge, okay, take the spaceship, take the pill, drink the punch, people do it. Why? Not because they think it's true anymore. It's not because they think the world's ending or that they're going to be on the spaceship going off to the next universe, but because I couldn't have done all this for nothing. I couldn't have disassociated with my family, mutilated myself, given up all my money, thrown away my education, threw away my career, threw away all my love for nothing. So I got to hold on to this hope that this might be true.
So in a market correction, when somebody panics and sells and goes to cash and holds and stubbornly holds and doesn't.
This is what you are likely to experience, and what killed so many people's wealth and destroyed lives for generations in the last recession in 08. And you have an escalation of commitment phenomenon. That this even though all the information in front of you is going to say you were wrong, right? If you were wrong and you sell and the market goes up, are you going to buy at a higher price? And you're not. And I've seen this happen with people, and it continues to happen. It definitely happened during COVID for some. And it's sad, right? Because now the market's going up, and to say that I sold at the bottom is just too painful. It's got to crash. And I have this wall of worry of all of these things, right, that are saying that the market's going to crash. There's plenty of data to tell me that negative, that thing that I decided back when I made the decision in the first place, I might still be right. And what just happens as the market chugs along and the world chugs along, and you could have gone on living some other life,
right?
That escalation of commitment phenomenon, and it just becomes too painful at some point. It's really a bad scenario to be in. So I think it's important for investors to know that, going to cash is the easy part. Whether you're 100% wrong over the long term, you're only going to be maybe right for some short period of time. So when do you get back in? And if you are concentrating your stock investments into one company or one sector or into cryptocurrency, like this can happen too. It crashes. Well, I'm long term. It's going to come up.
That's my favorite.
What if it doesn't?
Right.
What if it doesn't? What if you have all the data right now telling you this is a bad idea, but I already bought. I already put all my money in that thing. Did your crystal ball, was it working then? No, it wasn't. You had some idea about what the future was holding, and you could be wrong. And did you just bet it all and lose it all? And so we see these things happen in religious cult, this escalation of commitment, but we see it in these mundane categories like wealth management and asset allocation.
Well, like you said, what was it all for? I think with investors, it's just an admission of being wrong, and nobody wants to do that because, that's human psychology.
Yeah.
And you've got this confirmation bias, and you get stuck to it, and you look at all the data that tells you what you want to hear, and you don't want to hear the other data. And yeah.
So to summarize, looking back at history, we have a bad Q1, sets up a nice rest of the next 12 months. We have FactSet saying that we have more buy signals on the S&P 500 companies since we've had in over a decade. The last time we had a call like that at 55%.
September of 2011.
It was the market low. We have long-term history on our side to show us that it's better to turn off the news and invest for the long run. Could the market retest the lows?
Yeah, definitely.
For sure. How's that going to go?
Well, we had a correction. I mean, these things tend to do that. I mean, you have a correction, you have these little rallies. You could retest your lows. All of a sudden, people could be saying, well, it broke its 200-day, its 50-day, and it's going lower. But if you're a long-term investor, I mean, it's noise.
Yeah. The other thing in this FactSet article, by the way, the analyst average expectation of the S&P over the next 12 months was 16.8% higher price than it is today, breaking 5,000. Of course, who knows? No, they don't have a crystal ball either, but that's just what we're hearing. And I want to just end on this. I get sometimes a question during these, volatile periods. Like, I want to know what Presidio is doing to protect my portfolio. It's like, we did that on day one. Remember when we talked about your inflation taxes market crashes?
Right.
Remember when we created an assets, liabilities, income, expenses, or ALI strategy to understand all of your cash flow needs and liabilities, pegged with inflation, tied back to a model of assets in your portfolio today with risk of safety and growth and income and preservation and potential growth and all that kind of stuff, right? So just if you ask that question, we did it in the beginning. So so you're doing okay.
Yeah.
All right. Well, Jeff, good episode. And definitely love talking about this stuff. So we'll see what the next 2 weeks brings. I'm sure there's going to be more to come. We got some people paying taxes over the next week or so. So, everyone's going to be feeling it. So we'll talk about maybe what we could do to kind of lessen the tax bite for you this year. You got to get your planning done before April 15th, actually before December 31st. So more to come on that. But anyway, thanks for joining us here at the Presidio Perspective. We'll see you or hear you next time. Thank you.
Take care.